Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome back Craig Shapiro. He is with the research platform, the Bear Traps Report. Craig, welcome back.
Thanks for having me, Nick. Good to see you again. Happy holidays.
Happy holidays to you, Craig. So let's get into your take on the Fed and most importantly, the market reaction. What's going on? Yields are up really strongly this week here with the 10-year yield way above 4.5%.
Yeah. Look, the Fed commenced its cutting cycle earlier in the year, and with a 50 basis point cut in November, another 25 basis point. I'm sorry, in September, another 25 in November, and then another 25 yesterday. And all we've seen since they started to cut rates is higher and higher yields. So not exactly, I don't think, the reaction that the Fed was hoping for or thought they were going to be getting when they were cutting rates. But really, I think what we're seeing is the bond market starting to or continuing to become concerned about the Fed's desire and ability to slay inflation and bring inflation back down to 2% and ultimately keep it there. And so, over the course of the last couple months, inflation has been stickier than expected. And the Fed was forced yesterday to raise its expectations for core PCE for 2024, 2025, and 2026. And so now is expecting only to bring inflation back down to 2% in 2027. So it seems as though the Fed is pushing out the timeline once again. And I think the bond market has noticed that, continues to be concerned about that. Term premiums have risen on back of that. And so even though yesterday's decision, I think, has been described as a hawkish cut, meaning they cut rates, but they also reduced the amount of expected cuts in their dot plot for 2025 and for 2026. So a hawkish cut. The bond market is looking through it and saying 15 of 19 members have increased their concern about the upside risk to inflation. Another 14 or 15 of them are more concerned about the uncertainty around inflation, and yet they cut rates yesterday, and they expect to cut rates another 2 times in 2025 and again in 2026. And so why are they doing that? Why are they continuing to cut rates when there is concern that inflation is not going back to target? I think that is what the bond market is concerned about. Clearly, there's other issues with the bond market, with the deficits. We could talk about Trump and the tariffs and the like. But really, I think it's this idea that the Fed is going too slow in bringing inflation back down to 2%. Another year now expected. And so the bond market is growing concerned. And we've seen close to 100 basis points of backup in yields from the lows in September to where we are today. And it seems as though yields are going to continue to march higher until we get to a point where the Fed maybe gets a little bit more serious about it, or we start to see some evidence that the tightening is actually of financial conditions is actually going to slow it down.
What Craig suggests it reminds me of a term that we would use on the desk, which is compensation. That's the word that we use in fixed income. You want to be compensated for. In rates land, it's inflation. I mean, that is what you're trying to be compensated for. That is what brings you into a fixed income investment. So, Craig, the question is, because it's clear the market has chosen higher yields here. So I'm wondering, at what yield, both on 10s and then maybe the 2s 10s curve, were you more balanced in your approach? So meaning that we've moved higher in yield, right? So your thesis is correct that the market was underpricing this inflation. It was underpricing the Fed getting ahead of the curve. Basically, it was assuming that the Fed was getting ahead of the curve, but they weren't, right? Investors are demanding more compensation. My question to you is, at what level specifically, because I know you watch the charts on 10s and on 2s 10s, were you starting to come out of, hey, this isn't really a more balanced outlook. This is really looking like the inflationary worries are back?
Yeah, I mean, I hate to, just kind of put the number out there and just, I think people are concerned about 5%, right? There's been a lot of talk about 5% on tens as being, kind of this magical level where at that point the Fed gets concerned, Treasury gets concerned, the equity market gets concerned. I don't think really, ultimately we know exactly. I would have thought that by now equities would have reacted more negatively to this backup in yields. I mean, we're seeing it in smaller cap equities and highly levered equities that need lower cost of capital and lower financing costs in order to fund their operations. And so there's been some weakness and clearly some divergences where those names have been under a lot of pressure. But big cap tech is really continued to hold in there incredibly well until yesterday and even maybe to today. So we'll see. Maybe we're getting closer, but so I don't know if it's an absolute level per se, but I'd like to say that if we get another 20, 25 basis points up in the long end here, folks are going to start to notice. And I think what we have is a bit of this reflexive reality where as yields continue to move higher, the equity market starts to pick up notice, starts to sell off. And then, we're seeing that in the crypto markets. We're seeing that in other risk asset markets as well. And so this idea about inflation being stickier from the wealth effect, from strong asset prices, maybe that starts to unravel and that becomes self-correcting and bonds stop selling off. So, look, into year end, it's, I think a tough call to make, but as we head into next year, we also have to think about Trump and the policies and what's going to be, approved early in the administration or later on with respect to tariffs, with respect to tax cuts, the deficits, the Doge committee. So a lot of cross currents, but the rate of change of yields moving higher, I think, is starting to become an issue. And so if this were to continue here for another few days into year end, I'd be more concerned about risk assets, even into next week and certainly into January, thinking that we'd start the year with a risk asset correction. And, maybe we've already started to kick that off here in the last 36 hours.
As Bitcoin's role in the global financial landscape evolves, understanding its potential impact on your wealth becomes increasingly crucial. Whether we see a measured adoption or accelerated hyper-Bitcoinization, being prepared for various scenarios can make the difference between merely participating and truly optimizing your position. This is why Unchained developed the Bitcoin Calculator, a sophisticated modeling tool that helps you visualize and prepare for multiple Bitcoin futures. Beyond traditional retirement planning, it offers deep insight into how different adoption scenarios could transform your wealth trajectory. What sets this tool apart is that it's integrated with Unchained IRA, the only solution that combines the tax advantages of a retirement account with self-custody of Bitcoin. In any future state, maintaining control of your Bitcoin keys remains fundamental to your Bitcoin strategy. Explore your potential futures at unchained.com/TBL. Don't write your seed on paper. It's estimated that so much Bitcoin is lost forever, and the main culprit, the main reason, is poor seed phrase security. This is why we use Stamp Seed, a DIY kit that enables you to hammer your seed phrases into titanium plates using professional stamping tools. These plates are heat resistant up to 3,000 degrees, fireproof, crush-proof, and time-proof. They're compact and easy to hide, and they can be used in your single sig or multi-sig setups. Make sure you go check them out today at stampseed.com and use code TBL for 15% off of your order. When the Fed meets in March, that's the next time that they could cut, assumedly. So are they going to be, do you expect the Fed to say at that point, we're waiting to see how these policies play out and it's best for us to keep waiting here? Or do you think they're on some sort of preset path already?
So the Fed meets again in January and then they update the dot plot again in March. Powell mentioned yesterday that some of the Fed members have started to take into consideration things that may happen during the Trump administration with respect to tariffs, with respect to tax cuts. And even though last meeting he said we don't think about these types of things until their policy, but clearly, the Fed needs to be thinking about, and they're putting out a forecast for 25, 26, 27. They have to make assumptions about what they think might happen. And so part of what they think might happen has to do with what they think will happen in DC. And so it looks like some of the members clearly are a bit more concerned about what Trump policies, trying to run, a hotter growth outlook, tariffs, tax cuts, what that might mean. And so that seems like it started to pick up, some speed in this most recent reading. I think what we got yesterday from the Fed was certainly a pause for January. So I don't anticipate that they'll be doing anything in respect to January with respect to cutting. It'll be a week after Trump is inaugurated. I think actually this time it's before the next QRA. It's the week before or the week after the QRA. I'm actually not sure the QRA is the Treasury refunding announcement, but because it'll be the first refunding announcement under the new Treasury Secretary, I don't anticipate any changes in what they expect for duration issuance anyway. So I don't really think January is a live meeting, and I think that the next meeting that's live would be March, and there'll be an update to the dot plot at that point too. And the Fed will say it depends on the data, right? If the labor market remains robust and inflation doesn't show any momentum back down to target, and the comps are easy, and so it's likely that inflation is going to remain elevated as we head into the early part of next year. So I'd say if that's the case, the Fed's not going to be looking to cut in March, and so I think that's what we're looking for here. But as far as the policies of the new administration are concerned, I'll take Powell at his word. I don't think that's fully in the price. I don't think that's fully in the outlook for the Fed. But really, he mentioned yesterday, and I tweeted this, and I said, Powell was talking about a Main Street over Wall Street in his press conference yesterday. He sees an economy that is good. We had a positive revision to GDP again this morning, north of 3%. The Fed has been underestimating, and most economists have been underestimating the overall strength of the economy this year, underestimating the strength of the labor market and underestimating the strength of inflation. So I think he basically kind of put a line in the sand and said, the economy here is good and we're closer to neutral. We don't know exactly where it is, but there are members who think that the neutral rate is probably very close to where rates are right now. So with that being said, the Fed's going to go incredibly slow at this point to adding any additional accommodation, I think. And as long as the data remains robust, I suspect they're not going to be doing much in the way of cutting in the first half of next year.
Yeah, the bar does seem to be pretty high. There are some expectations that the Fed could still cut, 2 to 4 times here next year, but the bar will be high. I want to ask you about the dollar. Dollar has gotten stronger. It looks like there's a lot of problems in Europe and in China. I'm wondering if you can relate the dollar back to this, and if you can. One of your big themes, Craig, is the instantaneous feedback loop of financial conditions. And so we know that a strong dollar is a tight financial condition alongside higher yields. So what's the take on the dollar, and is there a trade there that you're involved in as well?
Yeah, I mean, if you even go back to 2016 after Trump was elected, the dollar staged a pretty aggressive rally, and we're seeing a similar rally this time. And look, I think it's being driven by a variety of factors, right? I mean, the growth differentials between the U.S. and the rest of the world remain wide and continue to widen. The U.S. continues to be the highest growth area in any developed market, and really anywhere. We're seeing the growth problems in Europe, in China, and now in some of the emerging markets that are struggling now with their weaker currencies. And so growth differentials favor the dollar. Yield differentials, if the Fed is not cutting because inflation in the U.S. is higher, then yield differentials are favoring the dollar. And the tariff regime that's being proposed by Trump also favors the dollar. I mean, if you think about a foreign central bank or a foreign government that knows that it needs to deal with the new Trump administration that's highly protectionist, that's going to be negotiating tariffs. My view is those governments want their currencies to be as weak as possible going into that negotiation with Trump. And they'll say, yeah, our currencies are weak. We're willing to make a deal here to strengthen our currencies if you don't tariff us. And that might ultimately bring their currencies back to where they were 3 months ago. And so I think all those pressures are against non-dollar currencies. The dollar will continue to be strong, but we're starting to see strain in emerging markets. Kind of reminds me a little bit of the taper tantrum in 2013, where Bernanke announced the beginning of tapering of asset purchases, and we had a yield move higher. We had a big dollar move higher, and it was a real problem for emerging markets in June through September of 2013. A similar environment is what we're seeing now. I mean, Brazil is under a tremendous amount of pressure. The real is, hitting north of 6. India is under a tremendous amount of pressure. Even the RMB is flirting with 730. Aussie, and then back to developed markets. Aussie dollar is in the toilet. Canadian dollar. I mean, it's across the board. And so this dollar wrecking ball becomes a problem for the rest of the world, and that feedback loop is coming, right? We will get an issue where global growth momentum stalls out. You'll see that more on the manufacturing side and on the services side and in the goods market. And so I think that also has been part of this divergence trade that we've seen, where services stocks in the U.S. have done much better than goods related companies. And so, but look, I think as we transition into 2025, you have slowing global growth momentum, but sticky inflation. You have Trump talking about tariffs. And so I think that's going to lead to more uncertainty in the global growth environment, in the tradable goods environment. And so that does concern me. And that concerns me for risk assets in the first quarter of next year, exiting 2024, after a pretty strong year, not the last 2 days notwithstanding, but I suspect we're going to walk into 2025. There's going to be some selling pressure. As folks start to kind of think about what 2025 looks like, with the Fed not really able to cut rates, with a dollar that is robust, with a protectionist administration, with geopolitical concerns that are still out there. A lot of hope about a peace dividend, but we'll see. And so, the outlook for risk as we head into 2025, I'm a bit concerned about.
And at what point does that feed back into lower inflation outlook and lower yields?
Look, I think what you'll see is you'll see it happen through financial asset channel, right? And so I think once we start to get equity selling, risk asset selling, some spread widening, credit spread widening, I think that heat will start to come off the wealth effect, and then you'll start to see the services economy in the U.S. start to slow down. You'll likely get a further slowdown in hiring. Is the Doge committee going to be successful in helping to reduce the budget, or at least the spending in 2025? Maybe. I mean, they're already starting to sink their teeth into this most recent negotiation to keep the government open over the holidays here. So that'd be some more pressure on spending for next year. So I think that's ultimately how inflation will come back down. It'll be through the wealth effect. It'll be through the financial markets that really need to come down in order to help the Fed bring inflation back down to target. I think, unfortunately, for whatever reason, the Fed has decided that the rates tool really is their only tool. They should have been more aggressive. We've talked about this. They should have been more aggressive using their balance sheet to tighten financial conditions when appropriate. Not hold as many long-term securities. They should have been selling securities as opposed to just letting securities roll off. They decided against that. And so the rate tool really is, they decided is their only tool. And so they've created this bizarre economy where certain segments of the economy and folks that are asset rich and homeowners have been doing incredibly well. Everybody else is doing incredibly poorly. And so ultimately rates will need to come down in order to help, those people out. But if we don't bring asset prices down with that, then we're never going to solve this issue. So I think for now, the Fed is allowing or is encouraged maybe by the fact that the long end and duration is selling off. It'll force folks out of some riskier securities, take some heat off of the wealth effect, and I think that's how ultimately inflation can start to come down. But once again, if the Fed kind of gets spooked out, or if we have a banking issue or something happens and prevents this from happening, and the Fed comes in again and stimulates, then all bets are off. So, and they've done that time and time again, right? We've seen them step in when there's been treasury market dysfunction 5 or 6 times, since the fall of 2019 and the repo crisis, and we'll see if they'll do it again. I mean, I hope they don't. I hope they allow this to play out, more from a structural and societal perspective than anything else, because we ultimately need the wealth effect to come down. We cannot allow wealth inequality to continue to run like this. But the Fed does focus on financial conditions and treasury market stability, and if and when they deem that to be an issue, I suspect they're going to be providing liquidity once again.
What about Bitcoin in this scenario? Does it get dragged down with other risk assets, or does it catch a separate fundamental bid in your view?
Yeah, I think for Bitcoin, if we were in, I'm not going to say normal, but under normal circumstances, yeah, Bitcoin would be getting hit, as it always does, on tightening liquidity, on yields moving higher, on a Fed that is being forced to allow the long end to rise, and with a dollar rally. I think this time, not to say this time is different, but the truth of the matter is this time is different, because the administration is pro Bitcoin. This is a striking difference from prior administrations, and really any time over the Bitcoin's life. And so you have a pro crypto, pro Bitcoin, I forget crypto, a pro Bitcoin president, Secretary Treasury, Commerce Secretary, and throughout the entirety of the Trump administration. And so in some ways, I think Bitcoin is going to become a bit of a scorecard for Trump. Maybe like the equity market was in his first administration. I think Bitcoin now could be seen as a scorecard for him. And so I think Bitcoin will suffer as risk assets suffer, but I don't think it will suffer as it has historically done. And we probably will get into a situation where Bitcoin actually can start to diverge and maybe show some relative strength against equities and other risk assets through this down cycle. And then ultimately really start to take off again on the other side here when we start to see the liquidity come back in, because we know, and look, I mean, whether a strategic Bitcoin reserve does actually happen or not, hard to say. Seems like the administration is pretty keen on doing it. I think that'll be beneficial. And so I think Bitcoin, will resume its upward trajectory, but in a risk off setting here, I don't think it will be saved. I don't think it will be saved.
There's a lot of debate around whether or not the strategy of having Bitcoin as a national asset, whether that's a good thing or a bad thing or warranted. But I agree with you that it does seem the administration is signaling that this is where they want to go. And I think it's an excellent point that Bitcoin is Trump's scorecard. We already know that he tweeted, "You're welcome," when it hit 100K. I mean, he actually said, "You're welcome." I think one of the things that I don't think people fully appreciate, I was on a trading desk during a Trump administration. His tweets move the market. It's a post as policy, as our friend Ian Lingen coined it, or I don't know if he coined it, but over at BMO Capital Markets, post as policy, it means when Trump tweets, it is going to move rates, it's going to move the stock market, it's going to move Bitcoin. Now he's actually targeting the Bitcoin price with some of his social media posts. So a fascinating time, something that there's no way I could have predicted something like that 12 months ago.
Yeah, I mean, I traded there as well, and it was exhausting, right? Because you'd have to, you'd have to think about who's he meeting with, and when is he meeting Xi? Is he going to have a great phone call? When is the next trade meeting? And that was, that was exhausting at times. And he would tweet at 2:00 in the morning, and markets would move. I think it is interesting from him being back because, from that perspective, what we've seen during at least the last several years, last 2-3 years, has been this explosion in zero data expiry options trading and options hedging, because there hasn't been a lot of overnight risk, right? You haven't really had, look, there's been times when geopolitical stuff has been out there. And so you've had to hedge, further out. But for the most part, it seems like increasingly folks have been more comfortable hedging portfolios on a daily basis, right, with zero data expiry. With Trump, that becomes a little bit more difficult, right? Because you do have overnight risk now. You have overnight tweet risk, right? All of a sudden tonight he could decide, hey, I spoke to Macron and we're going to throw a 25% tariff on Europe because I didn't like what he said, right? And in light of presidential authority and executive action, he has a lot of ability to do things on tariffs, things on Bitcoin, things in the exchange stabilization fund, things to control the dollar, right? There are things that he could do and likely will do that the Biden administration really and other administrations really have never done before. And so to the extent that that means that we're going to go back to some environment where folks have to think about hedging beyond one day out, I think that'll be an interesting change. But for sure, support of Bitcoin does seem to be top of mind, for him. And look, I think from a ownership point of view, very easy for anybody in America to still own Bitcoin and to buy Bitcoin at any point in time. And look, I mean, if some of the projections that you and myself and others about, and Michael Saylor kind of think about Bitcoin, where it may ultimately go in the next 2 to 5 years, right? There's still massive potential gains coming our way. And so I think, the administration and maybe Trump kind of views this as a bit of a wealth inequality alleviator, right? I mean, you have folks that could start buying Bitcoin now and still, earn tremendous gains. Where potentially buying into the equity market here at 6,000 is not going to lead to such a similar environment. So I think support of Bitcoin is it's great for Bitcoin holders, but I think it's also makes a lot of sense for the country. And I can see Trump kind of using that a bit more as a scorecard, as I mentioned, because it kind of fits with the populist agenda. It kind of fits with what he's talking about. I think it makes a lot of sense from that perspective.
I really think people need to understand this point that Craig is making about that Bitcoin is a populist agenda. And it's when Craig says it's good for the nation, I've put it in these words. The people actually elected for this as he campaigned on this topic itself and was vocal. Then when he got elected, he confirmed it. He has suggested that he is here for this policy. And it does. You say it's a scorecard. I classified it as that it's part of his recipe. This is part of his recipe for what he's going to come in with, and it's clearly part. Maybe not it's a main part or the number one part. I've suggested it's a top 10. It's in the top 10 of things that he's going to try here for the country. That alone, it's very bullish for the asset class, and it's quite bullish for a pair trade of Bitcoin versus the stock market. If you're thinking about that explicitly, which Craig, you just alluded to, I know You're not suggesting that trade itself, but that is, I think that's a good way to think about it.
Yeah, look, I think you just think about, his cabinet, right? I mean, and what the cabinet is doing to different parts of the stock market, right? I mean, the announcement of RFK as head of HHS, I mean, has really done damage to the healthcare industry, right? I mean, so, because he's thinking about coming after drug companies, he's thinking about coming after PBMs, he's thinking about coming after health insurers, right? And look, I suspect Trump, with respect to big tap tech, that seems like an area that's going to get regulated more. And so, yes, there's a deregulation campaign that's likely for banks and likely for small caps that eventually could be beneficial. But there are areas that, if the Doge committee is successful in cutting spending, and if the defense budget starts to come under pressure, right, there'll be areas of the stock market that really probably don't do as well under a Trump administration, particularly with margins for, a wide swath of industries that are closer to all-time highs than not. No, look, I think there is a case to be made for Bitcoin over the equity market, for the next at least for the next 2 years, and certainly Bitcoin over bonds, right? I mean, I think sovereign bonds, broadly speaking, as an asset class, and U.S. Treasuries specifically, I still am loath to want to own them. I just don't think they're being properly, as you mentioned earlier, properly compensated for taking that level of duration risk here with a government and with a Fed that is not expeditiously thinking about bringing inflation back down to 2%. I mean, 4.5, 4.75 for 10 years. It just doesn't really do it.
There needs to be not only more yield compensation, there needs to be more convexity compensation. And that's a topic in fixed income. You participate in a fixed income instrument, especially in the long end of the curve, because if there's an optionality to it that if yields fall quite a bit, you make increasingly more money. And with a low prospect of inflation or with a low prospect of deflation, Craig is saying that you're not being compensated for yield or convexity, or you're just going to need a much lower price to get that risk reward to the point where you are going to be attracted to pick up that convexity. I think Craig is suggesting that he doesn't feel yields have the ability to fall that far. Therefore, why would you even own that asset class just to clip a coupon if yields aren't even going anywhere? If they're not even going higher, 4.7 is still not enough to get him interested in the asset class.
Yeah. And with the Fed unlikely to be cutting rates, 3-month yield, 2-year yields at 4.2, 4.3, 4. I mean, you're still earning cash, right? You're still earning reasonable returns from cash at this point, and so you're just not, cash is still an asset, and so I am concerned about risk assets here. Cash is a fine alternative if you're looking to park money at this point. You can park it in 3-month T-bills still, and you're earning 4% and a 4.25%. That's okay while we wait things out. I mean, these are still historically high valuations for equities. Crypto as an asset class has had a tremendous move, and there's some, clearly some speculative froth in some of the meme coins and other areas. That there's just no rush into any of that stuff. Cash is an option, but you don't need to move out the curve here, investing in 7, 10, 20, 30-year bonds, because you're not really being adequately compensated. Term premiums are still more muted. The yield curve, although is starting to steepen, is by no historical metric is it average yet on average on compensation for what a normal yield curve would look like, 2s, 10s, or 5s, 30s. And so I think you're better off just kind of being upfront in the curve if you need to park cash, and kind of wait this next 2 to 3 month period out, where I suspect we're going to have turbulent markets, more volatility, this dollar rally, and uncertainty, and some likely equity correction that coming down the pipeline.
Craig, tell us about the Bear Traps report.
Yeah, so I recently joined up with Larry McDonald from the Bear Traps report. We provide an institutional and increasingly a retail research platform where we are having conversations with hundreds of buy-side investors around the world on a real-time basis, and trying to ascertain what is going on in the markets, what are professional investors thinking at any particular point in time. We assimilate all that information. We're analyzing cross-asset and trends, and then disseminating that information back out. So we have a written research product that we put out weekly called The Turning Point. And then I host a Discord channel where I'm in constant communication with our clients throughout the trading day, going through this information, having these conversations, and then kind of explaining to people what I'm thinking, what we're seeing, what we're thinking. And so yesterday, very active day, early this week, very active with the Fed meeting, and in real time, kind of analyzing what was said, what are some of the reactions, what are some of our recommendations. And so interesting place you can find this at thebeartrapsreport.com, and my Twitter handle is CES921, where I post some still posting regularly and getting into it with folks out there. So but look, it's an interesting place and interesting time of year, and I think next year there's going to be a lot of opportunity. So I'm looking forward to it.
Thanks, Craig, and we'll catch you guys next time.